I don't call myself a value investor anymore. I call myself a make money investor. I always knew that the growth of a business and the quality of a business was important, but my initial screen was the valuation of the stock, and that would be my universe. So to be a successful investor, you also have to understand all the ways in which your own mind, and every single human being, is prone to falling into these traps, so that then you can at least have a better than average chance of avoiding them. That's critical to investment success.
If you've been following business news over the past 5 years, chances are you've heard about the proliferation of self-driving car technology. Everyone is pouring millions of dollars into research and development for these new machines.
Electric vehicles and autonomous vehicles, separate technologies, but they're really being developed in tandem, and the next generation of cars have both of those features, is right at an S-curve inflection point upward. And so we've got 3 reports out, actually, naming 5 of our favorite stocks in the space. It has the potential to shake up certainly 2 of the world's largest industries, the energy industry and the automotive industry. There'll be huge benefits for humanity if we can reduce the number of auto accidents. More than 1 million people a year die worldwide, almost 40,000 in the United States in auto accidents, and many, many more suffer terrible injuries as a result. We're very excited about this. There'll be some huge winners, but also some industries that are going to go the way of the horse and buggy.
New York City is a great city. Every block, every neighborhood is different. Such a powerful environment.
It's a town, I think, where there's so much opportunity. There's also a lot of pressure. It says you either make it or we're going to go on to the next person.
New York has a mystique that tends to draw the most talented people in the United States and indeed the world to it.
Whitney Tilson is the American investor, author, and founder of Empire Financial Research, who graduated at the top of his class at Harvard Business School, then started his own hedge fund and grew it to over $200 million by becoming an expert in finding undervalued stocks and investments. But the best part is that after this episode, we filmed an exclusive video about some exciting investment opportunities in the electric vehicle and autonomous driving space. Whitney has been called the prophet by CNBC because of his uncanny ability to predict the future with his investment advice. And our video will not be available on YouTube or anywhere else but the link below. So click on the link below or go to londonreal.tv/invest to watch our video and download your copy of this free report. Unfortunately, I've been limited to the number of people who can have access. So act now to get your free copy and take advantage of this incredible investment opportunity. And now I leave you with Whitney Tilson. Enjoy this incredible episode. This is London Real. I am Brian Rose. My guest today is Whitney Tilson, the American investor, author, and founder of Empire Financial Research. After graduating top of your class at Harvard Business School, you started your own hedge fund and grew it to over $200 million by becoming an expert in finding undervalued stocks and investments. In fact, your calls have been so prescient that CNBC once nicknamed you the prophet. You're also one of the most connected men on Wall Street, having met Warren Buffett, Presidents Bill Clinton and Barack Obama, and an extensive list of Wall Street insiders. Today, your Empire Investment Report is one of the most sought-out pieces of investment advice today, coming from the man who predicted the dot-com crash, the market bottom in 2008, the housing bust, and the bubbles in Bitcoin, pot stocks, and 3D printing. Whitney, welcome to London Real in New York City.
Thank you for that kind introduction.
You're welcome. You know, I just wanted to tell everybody, we just recorded a separate piece talking about a really interesting report that you have coming out very shortly about the autonomous and electric vehicle sector, which we know is going through all sorts of changes. For people that want to get that report, there's a link below, or they can go to londonreal.tv/invest. Before we get started hearing about your background and your research, can you give us a little taste of what's happening in that sector? We've seen, Tesla moving rapidly up. You know, there's a lot of things happening here, right?
Sure. We think basically, if I were to give you the elevator pitch on it, is that electric vehicles and autonomous vehicles, separate technologies, but they're really being developed in tandem, and the next generation of cars have both of those features, is right at an S-curve inflection point upward, and there will be rapid adoption. Similar, the most recent example I can think of in the technology space is when Apple launched the iPhone in 2007, and in less than a decade, basically every person had a smartphone in the developed world, and more than half the adults on the planet Earth now have a smartphone. Go back and look at the curve on the adoption of the internet. And it just sort of poked along for a while, and then boom, it hit just almost a vertical inflection point. So, the human mind sort of process things linearly, but we think there's going to be an exponential growth and adoption curve here.
Wow, and it's not the obvious stuff. Just because Tesla stocks tripled, you're saying don't get caught up in looking at the big headline stories, because there's lots of other businesses that are going to be affected by this change.
That's right. I mean, most investors are just drawn to Tesla, and the stock has been just incredibly volatile as a result, but we think there's safer ways to play it, and a little more off the beaten path companies and stocks that are going to benefit from this forecast that we have. And so we've got 3 reports out, actually, naming 5 of our favorite stocks in the space, and probably stocks that very few people have heard of.
Wow, and like you were telling me on our separate video, it's not just about the cars, it's about parking lots, it's about highways, it's about ownership, it's about car insurance. I mean, there's so many sectors. Like you said, a geometric change, it kind of throws everything off. And as humans, it's hard to really comprehend what's going to happen.
Yeah, it has the potential to shake up certainly 2 of the world's largest industries, the energy industry and the automotive industry. But its ripple effects will be felt, in gas stations and auto lenders. There'll be huge benefits for humanity if we can reduce the number of auto accidents. More than 1 million people a year die worldwide, almost 40,000 in the United States in auto accidents, and many, many more suffer terrible injuries as a result. We're very excited about this. There'll be some huge winners, but also some industries that are going to go the way of the horse and buggy.
Right. I always think of we used to buy flashlights, and now when the iPhone has the lamp on it, like how many industries did it just send to zero with that iPhone that took the place of all of those random devices you had in your house? So yeah, so many opportunities here. You said as well that most people use their car 4% of the time.
Right, 96% of the time a car is just sitting there idle. And, for people who live in far-off rural areas, probably are still going to need to have their own cars. But for anyone, the vast majority of Americans and people in the developed world live in urban or suburban areas where, our grandchildren, or probably even my children, may look in wonderment, like, why did every single person have their own car that just sits there 96% of the time, when you can just pull up an app and a car will show up, an autonomous vehicle will show up. And this isn't pie in the sky stuff that might happen 10 years from now. Right now in Phoenix, Uber's got a setup. Google via Waymo has autonomous vehicles, and is actually, you can use an app and an autonomous vehicle will take you places. Now, it's what's called geofenced, meaning only certain routes in certain geographic areas. So it's not level 5 yet, but the vast majority of people are going between relatively fixed places, from their home to their work, from the airport to a downtown hotel. It doesn't happen overnight, but the pace at which this is happening is really incredibly exciting.
Wow. And don't listen to everything Elon Musk says, because like you said, 6 months ago, he was predicting this stuff in a year. So it's not necessarily his time frame, but there's other time frames, and there's other companies besides Tesla that are going to be involved.
His vision, I think, is correct, of a fleet of robo-taxis serving people who will no longer need cars. The time frame he laid out was completely delusional, but I think the consensus view, Elon Musk promised something in 6 months ago in a year, meaning 6 months from now, middle of 2020, let's say. He's quite a bit off on that, but I think the consensus view is 10 or 20 years out, and that's equally wrong. We're thinking, 3 to 5 years, autonomous vehicles become very common. Not complete level 5, in other words. They're not going to drive you out through a mountain pass on a dirt road or in the middle of a snowstorm, right? That's true level 5. But for large swaths of Americans in the majority of the trips they take, might well be in electric autonomous vehicles within 5 years.
Wow. All right, this is super exciting. I wasn't in Tesla, so I feel like my portfolio is missing out right now. So I'm looking forward to this report. Again, link below, londonreal.tv/invest, so people can grab that. I was wondering if we could start and maybe just ask you, how do you look at the stock market? So many people look at the stock market, they're confused, they're scared, they see the headlines, they see the crashes, and they don't even know how to understand it. They don't know if they should have part of their portfolio in stocks. This is something you've looked at for, over 20 years. How do you start explaining this to people who aren't educated? And how do you look at it? How has that changed over time?
Yeah. Well, I started out, I just had a general business background, went to Harvard and Harvard Business School, learned about businesses, but my parents were teachers. They met and married in the Peace Corps. And so I didn't grow up sitting around the dinner table talking about stocks or finance or investments. That wasn't, my parents didn't, I'm trying to think, the first 50 years of their lives, I don't think they owned a single stock. Only when I started getting into the business did they actually, start learning anything about it. So I came to it late. I was always interested in business. And I was very lucky. I was college buddies with Bill Ackman of Pershing Square, one of the best known, largest investors in the world. And he introduced me to Warren Buffett. When I first started getting into investing, this was after college, even after business school. And he said, go read everything Warren Buffett's ever written, and that's all you need to know. You can stop right there. That's all you need to know about investing. And I would still generally echo that advice. You can just type into your browser, Warren Buffett annual letters or shareholder letters, and that's a pretty good place to start. So
what is his philosophy, if you had to describe it? If I read 10 of those letters,
sure.
What do I see? A guy that's a long-term investor, a value investor,
yeah.
who doesn't get caught up with bells and whistles and trends?
Well, interestingly, he had a transition in his life. He was trained by sort of the godfather of value investing, Benjamin Graham. He studied at Columbia Business School under Benjamin Graham. And he was more of what's called a cigar butt investor in his early career, where he just bought statistically cheap stocks, trading at a discount to their liquidation value. He would buy stocks trading at 2 times earnings, and then they'd trade up 50% and be trading at 3 times earnings, and he'd flip them and buy another stock at 2 times earnings. So he didn't care about business quality, management, anything.
Okay. Why cigar butt? What does that mean? Because you're going to put that thing out?
The idea is if you're a real cheapskate and you don't want to buy a new cigar, if you search around, you can find a cigar butt on the ground that someone else has smoked and discarded, and pick it up and get one last puff. Now, it's not very satisfying, but it's free. You got something for nothing. So look, the two principal concepts of value investing that Warren Buffett has always preached are Chapter 8 and Chapter 20 of The Intelligent Investor, Ben Graham's classic book on investing. And the concepts are intrinsic value, which is what is something really worth, not trading stocks or whatever, but thinking of what is the value of a company, which is a function of its future free cash flows discounted to the present. And then margin of safety, which is stock market's pretty efficient. And it's forward looking. And there are lots of smart people out there. So most stocks are fully valued. They don't represent a good bargain. You're paying $1 for $1, if not $1.20 for $1, these days when you're 11 years into a bull market. So intrinsic value, figuring out what something's really worth, and then margin of safety, buying something at a substantial discount to its intrinsic value. Those are the two key pillars of investing. It's very simple in concept, difficult in practice. Both those things are difficult in practice. Figuring out intrinsic value means you need to be a good forecaster of the future of a business and what its cash flows will generate. Once you know that, it's easy to value, but figuring out the future is always difficult. And then the second part is difficult emotionally, which is you want to make money quick. The stock's really moving, there's excitement, and so being patient and disciplined and waiting for the occasional situation, because it doesn't happen very often, when you can buy at a big discount, when there's a big margin of safety. So investing is super interesting. One of the reasons I love it is because of the challenge, both the intellectual challenge and the emotional challenge, which is equally important.
Yeah, I mean, you can be your own worst enemy as a trader. You can make the decisions that are emotional based. I traded on Wall Street for about 10 years, and just getting your head around the stop loss and discipline, and it's a very difficult thing to do because your brain is logical and it's also emotional.
Yeah, there's a whole study called behavioral finance or behavioral economics, and people like Thaler and Kahneman and Tversky and people have won Nobel Prizes for studying basically the concept here. Those are all fancy words for how human beings are irrational when it comes to money. And even Warren Buffett, the most rational investor and one of the most successful investors of all time, has fallen into some of these traps, and it's overconfidence and commitment bias and overweighting vivid recent evidence and anchoring, and so to be a successful investor, you also have to understand all the ways in which your own mind, and every single human being is prone to falling into these traps, how you can fall, what the traps are, and what are the ways that you can get sucked into those traps so that then you can at least have a better than average chance of avoiding them. That's critical to investment success.
Would you say self-discipline is Warren's best trait?
Charlie Munger's once asked, what explains Warren Buffett's success?
And Charlie's his COO, right?
Yes,
CFO.
He's not CFO,
Partner.
his vice chairman,
Right,
and
okay.
his long time, for the last 50 years, partner, going back to the days when Buffett had the Buffett partnership and Munger had the Munger partnership. Interestingly, they've never lived in the same city. Munger lives in LA. Munger grew up in Omaha, but he's 7 years older than Buffett. So they didn't know each other growing up, but it was a small town. Buffett worked in Munger's grandfather's grocery store or something. There were some connections, and a mutual friend introduced them, though, when they were adults in their 30s. And they immediately hit it off and have been a sounding board for each other and partners in Berkshire Hathaway. Right. When Munger closed his Munger partnership in the early 70s, he basically threw his lot in with Warren Buffett. And Munger has a big ego, is a super smart guy. But he was also humble and smart enough to realize, as good as I am, and Munger had a good record as an investor running the Munger partnership, as good as I am, this guy's better. So he teamed up with Buffett in the early 70s, and Buffett's worth 50 plus billion, but Munger's a billionaire too. He's not complaining. So I'm sorry, I lost my train of thought.
I think you were talking about
question.
I think Munger had a point of view that you said. I don't know, that made him unique, and I'm not quite sure exactly what that was.
Oh, what explains Warren Buffett's success?
Yes.
And one of Munger's favorite terms is Lollapalooza effects. To get super big, dramatic change or impact, it's never one cause or two causes. It's multiple things all working together to create Lollapalooza effects. So I would argue, for example, in our prediction about the rapid rise in adoption of electric vehicles and autonomous vehicles isn't due to one or two developments. It's due to a confluence of things all hitting at the same time. Technology, video technology, radar technology, GPS, big data, artificial intelligence, et cetera, et cetera, et cetera. The reduction in battery costs, all of those things come together. So in Buffett's case, Munger points to, his success is partly being super rational, as you pointed out. It's having a big ego, but also being super humble. And that's what's missing. Almost everybody in the investment field has a huge ego, almost definitionally. We're all type A
we know that,
personalities.
Right.
But the ones who are successful are the ones who also have the humility and self-awareness to say, you know what, maybe I made a mistake here. It's time to get out. You know what, somebody's making a lot of money over there trading cocoa bean futures. I don't know anything about cocoa beans, so I'm not going to invest over there, even if somebody else is making a lot of money doing it, right? So Warren Buffett was, as a as a teenager in high school, was the smartest kid in the class. And in his high school yearbook, he was most likely to succeed. So he had a good brain for this, but then he also got lucky. He got trained by Ben Graham. So you can see all these factors put together, but basically to become world-class at anything, hitting a tennis ball, playing the violin, being a brain surgeon, a fighter pilot, or a superior investor, you need the basic fundamental challenges to get yourself on a super steep learning curve as early as possible and never ever get off it. And that's what's incredible about Buffett and Munger. In a couple days, I'm going out to Munger's annual meeting out in Los Angeles for a small company he's the chairman of called Daily Journal. He's 96 years old. And he's still learning. He's still a voracious reader. Buffett is too. So, Buffett started young, maybe age 10, and here he is at age 88, or maybe just turned 89, and he's still on an incredibly steep learning curve. You don't see many human beings still getting better with age at the age these two guys are.
Right, so that gives them the edge and allows them to take the wisdom but still keep learning, have the ego but stay humble. And that's what makes great investors, probably great human beings as well. You've been to 21 of the last annual meetings for Berkshire Hathaway in Omaha. What are those like?
It's sort of it's a little bit hokey, it's a little bit cult-like, but Berkshire Hathaway and Buffett and Munger are such good people. They're so high integrity and they represent such good values that they tend to attract people like that. I discovered Buffett after I graduated from business school. It wasn't until I was in my late 20s that my friend Bill Ackman, told me about him. I'd sort of heard the name, but I'd never read his letters and so forth. So I started going out to the annual meeting, and I just found, my main reason in going was I had just started my own little hedge fund. I had $1 million under management, and I didn't have any experience or training in the industry. So I really wanted to learn so that I could make a lot of money. So it was very selfish. But I keep going back, even though they still now keep giving the same answers to the same questions after 21 years. This will be my 22nd consecutive year this May. It's partly to sort of recharge my sensible investing batteries because, you sit here in New York like I do, and there's just so much nonsense swirling around, and everybody upgrading and downgrading and trading here and buying options there or whatever. And just going back to the source of wisdom that these guys have. So I would say that's one reason, the investing side. And interestingly, though, I'm writing a book on avoiding calamities and sort of life lessons. I'm writing it mainly for my 3 daughters, aged 23, 20, and 17. But I hope other people get something from it as well, which is life lessons that I've accumulated in my 53 years that I want to share with my daughters. And I figured, why not write a book about it? And maybe it'll have some good lessons for other people as well. But I really cite Buffett and Munger for a lot of those lessons. My parents first and foremost, but Buffett and Munger probably a close second. They really taught me a lot of things that made a huge difference in my life outside of investing.
Wow, so you really learned a lot from these guys.
Yeah.
And one thing I think Warren is all about is if he doesn't understand something, he doesn't invest in it. And so, you hear him talk about crypto. He says he kind of missed the internet and said, I didn't think Amazon was going to be a thing. Yeah. But he's okay with that because that's also kept him out of a lot of other potential problems. Are you the same way?
Yes. Most people think of investing, and by the way, life in general, as how can I make that big leap forward? Take a big step up. And what Buffett and Munger preaches, both in investing and in life, is actually once you have a roof over your head and your basic needs are taken care of, your main objective should be avoiding going back to avoiding calamities. And in fact, that's the title of my book that should be out in a few months. It's called "All I Want to Know Is Where I'm Going to Die, ... And it's a quote from Charlie Munger, quoting somebody else, I don't know who, but all I want to know is where I'm going to die so I never go there. And I remember when Munger said it at an annual meeting 20 odd years ago, and everybody laughed, and he said, no, I'm serious, which is, once you've reached a certain point in life, you should first and foremost be focusing on the kind of calamities that can blow you up. And that applies in investing, and that applies in your life as well. So it's very very powerful wisdom. They practice that. Munger was once asked, what explains the Berkshire Hathaway track record, the incredible track record? He said, you know what? It's not that we've been absolute geniuses and made the most brilliant investments and predicted all the trends. He's like, it's just applying basic common sense to avoiding the obvious calamities of putting all your money in some crazy company that blows up, or using too much leverage or whatever. They almost never use options. They don't do short-term trading. They never ever take on a dangerous amount of debt, so that when 2008 comes along, they were the last man standing and were able to put $50 billion to work at distressed prices because everybody else had been out there, pushing the limits.
Right. So just long-term investing, value investing, nothing crazy, but just always having those returns and never taking those big hits.
Yes, but what I will say though is, it's incredible to see guys this age making investments that they never would have made at the age of 78, that Buffett is making at the age of 88, something like Apple. So that's a technology company. And for years, he said, technology is all very exciting, but I can't predict it, so I won't invest in it. And he sort of had these blinders on. And I had those blinders as well. And so it just kills me, the incredible stocks I missed, companies that I was using their products. I had one of the first iPhones. I was buying my books on Amazon back even before the company went public. That's how long ago it was. I think Buffett and Munger have changed and adapted to and learned and grown and gotten rid of those blinders. It wasn't just technology, it was airlines, it was railroads. No self-respecting value investor would ever invest in those sectors. It turns out those industries changed over time. They consolidated. They went from horrible businesses to decent businesses. The railroads are pretty incredible businesses. Go look at the profit margins of the major railroads in the United States. They're among the highest in corporate America now, railroads. Wow. The key to investment success is also not putting your head in the sand and just sticking to what Ben Graham taught the better part of a century ago, but by always learning, keeping an open mind, and adapting to a new world while being very careful not to stray outside your circle of competence and get yourself into trouble.
Right. How do you invest, and has that changed over time? And how could you tell people about it or educate them on that?
Yeah, well, I used to just call myself a value investor. I pray in the church of Graham, Dodd, Buffett, and Munger, right? And that had sort of very clear things. But I would say the biggest mistake I made for the first almost 20 years of my career is I was really focused on valuation. That's what a value investor does. And growth investors just cared about growth, right? But I would argue that I don't call myself a value investor anymore. I call myself a make money investor, right? Because that's really the goal of investing. And by changing the terminology, I think it opens my mind up a little bit more, which is, if I were to summarize it, I would say I always knew that the growth of a business and the quality of a business was important, but my initial screen was the valuation of the stock. So I would cast a net out there for stocks trading at less than 10 times earnings, or a financial company trading at less than book value. And that would be my universe, maybe 100 companies. And then I would sift through those 100 statistically cheap stocks, and I would look for better businesses. And every once in a while I'd get lucky and I'd find a really high quality business that had just gotten trashed, like McDonald's in 2002 into early 2003. Stock went from 44 to 12. This was one of the most widely held stocks in America. It was down 80% or so. And so you could buy a world-class business at a statistically super cheap price. And I rode that up into the 60s for 6 years. It was one of the best investments in my early career. But when I look back, that was more of an outlier. It was very rare to find a world-class business that really got cheap on traditional valuation metrics. So I missed huge numbers of great companies. Today, I have the opposite approach, which is I cast a net out there looking for the 100 best businesses I can find. And then I search through them, trying to find stocks that aren't wildly overvalued, that might be somewhat undervalued, where I can get in at a price where I can look myself in the mirror and say, I'm just not, being crazy on the valuation. Because what I found is that over 5 years, 10 years, certainly longer than that, the return I earn as an investor is 80% determined on how the business performs, and only 20% on how cheap the stock was and how clever I was at getting in right at the bottom.
Okay. So you're not worried as much about getting that real outlier. You want to invest in something that's a good, decent value and then grows as an intelligent business over time.
Yes.
Now, we talked about the electric vehicle and autonomous earlier. Obviously, you got the special report, link below, londonreal.tv/invest. That's kind of a new sector to look at. 10 years ago, you wouldn't have necessarily looked at that sector. Right. How do you adjust your mentality to look at something like that? And why did you change to where that was interesting to you?
Yeah. Part of it is I guess I just got older and wiser. Part of it is underperforming this long bull market got pretty frustrating. Trailing the market and having your investors think you suck focuses the mind, so that's the dilemma every investor faces. Of course, is change. Are you just responding to short-term external stimuli that can lead you in the wrong direction, or is it that you just need to expand and open your mind and so forth? So notice that when I talk about my enthusiasm for electric vehicles and autonomous vehicles, I'm not saying run out and buy the popular stock everybody else is buying, Tesla. I'm instead looking for things that are outside the radar screen of every random retail investor that's pumping up Tesla stocks. So you have to have a broad toolkit to be a successful investor. You need to understand strategy and marketing and competition, and you need to be able to read financial statements and calculate return on equity and return on assets and free cash flow. You need that kind of toolkit. You need to have experience in a lot of different industries. And you also need the emotional toolkit and understand all the behavioral finance stuff. And I think you need a growth investor's toolkit and you need a value investor's toolkit. And having been trained by Buffett and Munger early in my career, I really only had the value investor's toolkit. And the last 11 years where traditional value investing is vastly underperformed traditional growth investing, is really underscored for me, hey, you better learn how to think like a growth investor as well as like a value investor. And people who can do both, who have a big toolkit, are the ones who are going to be most successful.
Right. And when someone subscribes to your Empire Investment Report, what are the kind of things that you pass on to them? I think you said that you're not into necessarily stop losses. You're about holding on to winners and riding them for a long time. What are the kind of things that you do differently in your report?
Yeah, well, basically what I try to do is take advantage of 2 decades of being in the hedge fund trenches. And I have a second book that's coming out. I'm parallel processing 2 books right now.
Congratulations, that's hard.
Not really, I didn't plan to have them end up at almost the same launch date, probably within a few months from now. But it's the title of the book is The Rise and Fall of Case Capital, which is the name of my hedge fund, and it traces the incredible success I had in my first dozen years through the financial crisis, nailing the internet bubble, nailing the housing bubble, starting with $1 million out of my bedroom, growing to 200 million plus, being on 60 Minutes twice, on CNBC weekly. They're calling me the prophet, because I predicted the housing bubble and what would happen and so forth. And then
that's amazing in itself.
Yeah, it was a little bit of luck, but a lot of hard work, finding the right mentors, learning from the right people, starting with Buffett and Munger and having Bill Ackman as a college friend and sitting in on Joel Greenblatt's class at Columbia Business School and reading Seth Klarman's book, Margin of Safety, his classic, and so forth. So, it wasn't pure luck, but the old saying, the harder I work, the luckier I am. But then I sort of managed to mess it up. Post-financial crisis, The financial crisis was so traumatizing in many ways to me, and seeing stocks that I had been, buying at 10 go to 2 in a matter of months, and I sort of hung in there, and they all came roaring back. But I kept seeing another crisis around the corner, so I got very defensive. And so, look, anyone who has owned mostly traditional value stocks, who's had cash and who's had a short book, has underperformed significantly in the last decade or so.
And there's a lot of those people. A lot of people have been predicting crashes for the last 4 or 5 years. We've never seen a bull market last this long. When we thought unemployment wouldn't go lower, now it's gone lower.
Right.
So like you said, it's a strange time. A lot of people were traumatized, whether they knew it or not. That's the thing about trauma, is you don't even know you have it, right? You kind of, pass it over in your mind. And so you're saying that everyone was kind of waiting for that to happen when the stock market just kept going.
Right. So it was only when I closed my hedge fund at the end of 2017, really in frustration. I felt like I'd lost my mojo and had, I hadn't lost my investors' money, but I had underperformed a bull market for sure. And after 12 years of crushing the market, I tripled my investors' money in a flat market, my first dozen years or so. It was very frustrating, and I didn't feel. I guess I sort of felt like Buffett did back in 1970 or so. Like I couldn't figure out the market, and it was only after I closed my fund that I realized how much weight it had sort of been on my shoulders, but also it made me realize that I had these blinders on, and I had sort of dug in my heels and just said, this whole market's a bubble, and I'm just going to sit here with a ton of cash, a big short book and all. And that was completely the wrong way to play it. So now, rather than, after sort of sitting out for a while and teaching a bunch of investing seminars for a year and a bunch of young investors, all the lessons I'd learned over the years, I decided to team up with my old friend Porter Stansberry at Stansberry Research and create this new business, Empire Financial Research, and our first newsletter, the Empire Investment Report, where I can take all the learnings and being in the hedge fund trenches, but also the benefit of being out of the hedge fund trenches and having a little perspective and actually writing a book about my whole career as a hedge fund manager. And that I don't feel like I don't have that weight on my shoulders. I don't have the blinders on. I can pick and choose from both the traditional value and traditional growth investing. And I can find, old school beaten down value stocks like Spirit Airlines or American Outdoor Brands, which makes Smith & Wesson guns, right? Sort of Altria, the old Philip Morris. I almost said Philip Morris, which is now a separate company, but Altria, out of favor, beaten down traditional value stocks. And at the same time, which have done well, by the way, and at the same time, recommend something like Virgin Galactic Holdings, which is a SPAC that merged with Richard Branson's space tourism venture. That stock's almost doubled for us since we recommended it 2 months ago. So if you looked at the portfolio, it wouldn't look like anybody else's portfolio because half of it is traditional sort of beaten down value stocks and half of it's much growthier oriented, but it combined, it works.
And you had to get out of the fund business in order to have this new perspective on the market.
Yeah, I look back and wish, wouldn't it have been nice to keep 50 million under management, which I still had despite years of underperformance. But the problem is if I hadn't actually returned the money and taken some time off, I don't think I would be nearly as good an investor as I am today.
Right. That's fantastic. All right, again, links below if people want to find out more about the report and to get that from you. What about this bull market? How do you look at it now? I mean, have you ever seen a bull market this long in your lifetime?
Well, keep in mind, I grew up and first started learning about investing in the mighty bull market from 82 to 2000. It was an 18-year bull market. Now, I think there was, some period in there where the market dipped a little. So technically speaking, the one we're in right now is the longest bull market. But actually, I would argue that was a much longer bull market. And keep in mind, it ended with this enormous blow-off like I've really never seen before of the whole internet sector. It was insane. And keep in mind that anything outside the internet sector, like Berkshire Hathaway stock, got cut almost in half in the first year that I was out there running money in 1999, when the Nasdaq, I think, was up 86% that year. So my take on the current market is first and foremost, I generally have learned a lesson that absent absolute extremes, it's just best not to have an opinion on the market. Okay. And I don't think we're at an extreme frothy point. There have been pockets, and I've made some big calls where particular sectors, the 3D printing sector, Bitcoin when it hit 20,000 for a day in December of 17, the cannabis sector when in September of 18 when Tilray hit 300 for a few minutes. I made some big calls in some particular areas, but those
to short those or get out of those. The bubble was too high.
Yeah, exactly. But across the board, when I look at the 100 biggest stocks that probably comprise 80% of the value of the S&P 500, the world's largest index, stock market index, I don't see huge overvaluation. Things are definitely at the high end of historical valuation ranges, but I'm not seeing a gigantic bubble that I think is likely to burst. So mostly, I just don't have an opinion on it, and I've certainly experienced an 18-year bull market. We're 11 years into this bull market, so there's nothing historical or mathematical or chronological that tells me this bull market has to end sometime soon. The U.S. economy is pretty darn healthy, and the kinds of things that really blow up markets or economies generally isn't on the stock side, it's on the debt side. The world's debt markets are something like 5 times larger than the world's combined market cap on the equity side. And by the way, equity investors are accustomed to, they don't like it when their stocks go down, but they're accustomed to some volatility there. Debt investors want to get paid, and if they worry, not just about the interest rate they're getting, but if they start to worry about their principal getting impaired and taking big losses, that's what freezes up the world. That's what happened in 2008 and 2009, and I don't see that happening. I mean, there's a lot of hidden debt over in China. Japan's probably over leveraged. Europe still hasn't cleaned up its banks, but I don't see anything like. I really got a strong feeling, and I went super public, and I ended up getting on 60 Minutes, predicting how bad the last financial crisis was going to be, because I could see all of the fraud and the leverage and the off-balance sheet stuff that most investors weren't aware of. And when that all started to go bad, everyone got blindsided and panicked. And there was a panic. There was a run on the bank, essentially, that only the deep pockets of the U.S. government, just pouring unlimited money into the financial system, was able to stabilize things, right? I don't see any analogy today where we're like on a trigger, a knife edge that could tip us into something calamitous.
It's really interesting. You look at the debt markets. I mean, I was in the fixed income business for many, many years, and like you said, we always expect our principal. It's like how many basis points you get on it, and when that starts happening, when the principal becomes in question, then you're looking at big problems, potentially globally for sure. For the average person, how do you recommend they invest their money in the stock market? Should they give it to a fund manager? Should they, make intelligent picks themselves and try to stay abreast of the market? Mm-hmm. Should they be in the stock market, everyone? What are your thoughts on that?
Yeah.
The following success secrets are only available inside the London Real Tribe, where you get exclusive access and insights from our high-performance guests on wealth creation, productivity, leadership, morning routines, health, and well-being. To join our tribe community, go to londonreal.tv/tribe. Now, let's continue with the show.
You mentioned crypto. What are your thoughts on crypto overall, now, in the future?
Well, Warren Buffett called cryptocurrencies in general rat poison squared. And I've been very vocal, not just about Bitcoin, but the whole crypto sector is just one to avoid. I think the underlying blockchain technology, and I've really tried, unlike in my early life where I just would have written it off, I've actually made an effort to try and understand this new technology and new area. And so I don't claim to be an expert on it, but I have put in some time into trying to understand it. Blockchain technology clearly has valuable applications that some of the big banks are using. And there's a pretty inefficient global financial system where just transferring money to another country can take 3 days and you get charged a 7% fee for it and so forth. So I think there's some exciting applications for blockchain technology. But the bet on Bitcoin and these cryptocurrencies is that somehow they will become accepted as mediums of exchange. And I think that will never happen because if I'm selling something to you or buying something from you or whatever, it can't be in a currency, a cryptocurrency, where the value is fluctuating by 10% every day, right? It's just impossible. Now, I was down in Argentina a couple years ago, where they've devalued their currency and they've gone through financial crisis after financial crisis, where some people are actually using Bitcoin to sell an apartment or something like that. But that's only because the alternative, their sovereign currency, is just a complete disaster, right? I don't think that speaks to the U.S. dollar getting replaced anytime soon. I just came back from Kenya this morning, and the U.S. dollar is really quite a global currency, accepted in virtually any country. Whenever I travel, I always carry a lot of U.S. dollars cash, because, and so I don't. So so part of it is I'm skeptical of the entire concept of that any cryptocurrency will ever be widely accepted as a medium of exchange. So what does that leave you with? It leaves you with two uses. One, just rank speculation, which is pretty much what's going on. But two, for illegal transactions and so forth. And I don't want to have anything to do with either of those. So I just warn people to stay away from that sector.
Pot stocks.
Yes.
And then maybe talk about CBD stocks as well,
Yeah.
but maybe pot stocks first.
Yeah, I lump them together. But
okay. What has happened for people that don't know, and what's going to happen in the future?
Now, this sector, unlike cryptocurrencies, is there are some similarities in that they both had huge bubbles. The crypto, Bitcoin's peaked at 20,000. I don't know, it's at 8,000 today or something like that. So it has not fallen as far as I thought it would, actually, at least not yet. Whereas a lot of pot stocks are down 90% or more. The sector's gotten entirely decimated. But here, unlike cryptocurrencies, I think there are fundamentals here in that you can analyze companies that have real revenues, mostly losses, but you can project perhaps future profitability. The legal environment is changing and generally is a significant tailwind here. There are lots of legitimate medicinal uses for CBD and or marijuana or its extract, cannabis oil and so forth. So I personally think there needs to be quite a bit more study before I would be in favor of just broad legalization, particularly young people using too much of it. It's been linked to schizophrenia, with some people sudden violence and so forth. So I certainly would not want my own daughters using this product, but I think decriminalizing it makes a lot of sense, and I think there's a very favorable regulatory tailwind in the entire developed world, not just the United States here. And the fact that the sector's gotten decimated reminds me a little of when stocks back, the internet bubble stocks, from 2000 to 2002, companies like Priceline, now Booking.com, went down by 99%. Amazon went down by 90% or more. And you could find quality companies. So when a bubble bursts and the entire sector is down 80 or 90%, some stocks are down by 99%, that's where I go looking for bargains and trying to find real companies with real products, happy customers. And that's so I think there's opportunity there. And interestingly, my partners at Stansberry Research have a newsletter on the pot sector, and they had the guy who writes that newsletter had the misfortune of launching it about a year ago, and the sector has continued to get decimated. So his initial picks have outperformed the sector, but they're still down a bunch. But I actually think this is where smart people can wade in, and if you can develop some expertise in the industry, you'll probably find bargains there. So that's where I would look far more than in the crypto area.
Yeah, it is a commodity that will have use for human beings. I just think it's not what everyone thought it was going to be with all the deregulation. And we've seen the subsequent valuations come down. Are there any other sectors that you like to comment on that sometimes people go into when maybe they shouldn't, or not understanding? I mean, I know you called the 3D printing thing, but is there anything else?
Yeah, well, look, just generally speaking, where I find the most fraud and where you find the promoters and so forth out there tends to be in medical breakthroughs, the biotechs and so forth, natural resources. We've discovered the next gold mine or natural gas field in some obscure African country or something like that. So just generally, there are always promoters out there, pitching, trying to get people excited and sucked into things. And, generally speaking, sticking with solid companies, having a foundation of your portfolio, blue chip companies like Berkshire Hathaway as a foundation. And then if you want to have a little bit of, those kind of companies, you hope to double your money in 5 years. And then have a little bit of money that if things work out, you can double your money in 2 years. But you're going to take more risk and there's going to be more volatility there. And look, if you want to have a few percent of your money in really beaten down stuff where you can make 10 times your money in pot stocks, this is a sector that could look like the internet sector, where 10 years from now you'll have 100 baggers from some of the stocks that are really beaten down today. But that should be a very small part of your portfolio.
Right. And if people want to learn more about the Empire Investment Report, there's a link below, and also about that autonomous and electric vehicle report, or it's londonreal.tv/invest. Now I got to ask you about getting trained by Navy SEALs.
Yes.
Also, we both have had some contact with Alex Honnold,
Yes.
who free soloed El Capitan. And I hear you're out there to climb El Capitan at 53 years old. Can you tell me about your crazy personal life?
Yeah, well, I've always, just loved the outdoors and sort of challenging myself. But I'd say 5 or 6 years ago, as my 50th birthday approached, I'm 53 now. So this was in my late 40s. Looking back, maybe it was a bit of a midlife crisis, but I signed up for this program some ex-Navy SEALs were running out in Coronado and in San Diego, where they train SEALs in the so-called BUDS program.
Is Mark Devine and those guys?
Yeah, those kind of guys.
Yeah, okay.
There are a bunch of them out there, and they put a bunch of middle-aged people, business people like us, who sort of paid a lot of money to go through, get what I call BUDS Light, a three-day weekend-long taste of what the SEALs. The core elements of the SEAL train. So we swam a couple miles in the ocean in the middle of the night, and we carried logs, and we paddled the rubber dinghies out in the surf, and they put us through PT, the physical training that they give the SEALs and so forth. And I couldn't walk straight for a month afterward. I was so sore, and I was freezing and miserable, and of course you didn't get any sleep or whatever, but it really pushed me outside my comfort zone, and it was a miserable but exhilarating experience. And so I started searching for other things, really going outside my comfort zone.
Did you ever want to quit the BUDS stuff?
In the real BUDS, about 80% of people ring out. Yeah. They quit because it's so brutal. They try to get you to quit because they don't want anyone to become a Navy SEAL, whoever might quit on the battlefield, right? Yeah. This was a for-profit business run by ex-SEALs who they tried to push each individual to their limit and beyond their limit, but they didn't actually want you to quit because that would be bad for their business, right? So no, there was no point at which I was on the verge of being out of here, but they could have easily pushed me over that point. I have no doubt that I would have had a breaking point.
And it was horrible.
But
were they talking trash to you as well? Like,
oh yeah, and they're always screaming, "The only easy day was yesterday," and "Embrace the suck," and they have all their sayings. But I started doing Tough Mudder and Spartan races, which was a little somewhat similar to that, and ended up really getting into that. I'm very proud to say I'm the all-time record holder in the 50 and older age division at the world's toughest mudder, which is a 24-hour Tough Mudder race.
That's a serious race, that 24-hour race.
Yeah, I did 75 miles, 300 obstacles, wearing a wetsuit and getting electric shocks and barbed wire and all of that.
24-hour race.
Yep.
Wow.
I've done it 4 times now. I've won it, the 50 and older, twice, and a couple guys tied me this year. But so 3 of us actually have done 75 miles in that race, which is the all-time record for 50 and older folks. So part of my one new area of challenge for me is climbing mountains. So I went to Europe and I climbed a bunch of peaks in the Alps over the last few years, and then I saw free solo. And I started doing some digging around on the internet. El Capitan is considered the most iconic rock climb in the world. Every climber aspires to do it at some point in their lives. And believe it or not, an amateur like me can do it. Now, Alex Honnold did it with no ropes in 4 hours in the movie Free Solo. An amateur like me, you have to hire a guide, and they go up and they set ropes. And the difficulty, there are 50 different routes up El Cap, but all of them are a degree of difficulty where I could never climb it without the aid of ropes. So it's called aid climbing. Use the ropes. And so you got to work with your guide, and you're always roped in. So it's expected that you will fall on many occasions, but you got the rope, and you spend 4 nights camping on the rock in these portaledges, in your sleeping bag out there. So in a couple days, I'm heading out to Yosemite to do some training on some smaller rock faces with my guide. And if all goes well, I'm probably going to do 2 one-week trips out there to train with him. And then if he thinks we're ready, we'll hopefully do a 5-day summit of El Cap later this year.
That's intense, Whitney.
Yeah, very exciting.
I know Joe DeSena from Spartan Race, and I know a guy named
He's quite a guy.
He's great, yeah. And I know a guy named Ben Greenfield who did the 24-hour toughest mudder. I think he quit the first time, and Ben's really hardcore. I mean, he said it was really hard.
Yeah,
I've done the Tough Mudder myself, and those electric shocks is not something I want to do again.
Yeah.
I'm sure the voltage is cranked up on the 24-hour one. So
yeah, it was. You have to. A lot of it is, when you're going through. Part of the reason I do it is, it's a midlife crisis and all. But part of it, I think, makes me a better person, a better investor, because boy, you have to be able to cope with things going haywire, feeling totally beaten down. And yet having the resilience to overcome it, to be able to think clearly when you're under duress. I don't want to make too many analogies between getting huge electric shocks and losing money in the stock market, but I think part of this, I'd like to think part of this is not just me having a midlife crisis, but it actually makes me a better, stronger person, and that has beneficial effects in the stock market.
yeah, I could see that. What does your family think of all this?
Well, it's sort of funny. I joke, a couple things. My mom really freaked out, tried to organize an intervention. And
for the climbs or for the mudder?
Yeah, I think it was the Matterhorn, climbing the Matterhorn 3 years ago.
It's dangerous.
But look, when you're roped to a world-class guide at all times, I would never set foot in these mountains. I understand that I'm an amateur.
Right.
And so I pay a lot of money to have world-class people, and I'm roped to them at all times. If I go, they go. Okay. So our interests are aligned.
Right.
I made a couple different arguments. The first thing I did is I went out and got a huge life insurance policy because, look, there is tail risk to this. I do everything I can to mitigate risk. I have no desire to climb Everest, which is just has a death rate, an uncontrolled death rate that I'm just not comfortable with. Okay. Right? So I'm not climbing.
Because it's subject to people up there and traffic problems.
And you got to go through the Khumbu ice fall, and sometimes the giant ice boulders just fall and kill people. And it's just completely random. You could be the best climber in the world, right? And anytime you're up in the death zone, up above north of 25,000 feet, anything goes wrong and you're going to die up there, right? Whereas the highest peak in the Alps is 15,800. Mont Blanc, right? So you're at half the altitude. that you would be up in Everest. I joke that ever since I got a $10 million life insurance policy, my wife is like, honey, do you really need a guide and ropes? I really admire Alex Honnold. Have you thought about taking up free soloing, honey?
Is that an expensive policy based on what you do? Or?
What's really interesting is it costs $8,000 a year, $10,000 a year, which given the crazy things I do, I think the insurance company is underpricing my risk. But
Buffett's probably right in that risk.
But somebody
somewhere, right?
told me, they said, Whitney, if you die like scuba diving or skydiving, which I also do, or rock climbing or something, they won't pay because there's an exclusion in the policy. And I sort of freaked out. And so I called up the insurance company. I said, just hypothetically, if I were to die, rock climbing or something, would you still cover, or are there exclusions? And the woman on the other end of the phone laughed and said, you die, we pay. There are no exclusions, right? So my wife was in the next room and I said, hey, Susan, good news. You'll still collect the 10 million. But look, the other thing is I rock climb 1 week a year, maybe 2, right? I ride my bike in the streets of Manhattan 200 days a year. So I tell my wife and I tell my mother, look, if you want to worry, fine. But what you should be worrying about is every time I walk out of this apartment, get on my bike, because the streets of New York are dangerous to be. It's not like Amsterdam where they have beautiful bike lanes and so forth, right? Yeah. So, but one of the chapters in my book on calamities that's coming out in a few months is how do you reconcile, how do you balance backcountry skiing where there's avalanche risk? I do that too, right? I do things where there's risk, and part of it is the same as in the investing world. Any investment you make has a degree of risk. You want to think very carefully about the risk versus the reward. And the reward here for me is living life to the fullest. And I just get incredible joy standing on the top of a mountain that only 1,000 people a year climb or something like that, right? And so, but also at the same time, there are ways to mitigate risk. And so I think super carefully about anything I do that has risk, from riding a bike. I just went out 2 weeks ago and I bought a brand new bike because my old bike, I didn't feel like my brakes were working super well. And I look like a Christmas tree. I have very expensive, bright blinking lights on my helmet and on my bike to make me visible, so it's less likely that a car or a truck gets me, right? Yeah. So in everything that I do, from hiring a guide when I rock climb to training properly for these races that I do, et cetera, to avoid injury, et cetera, there are ways to do risky things that mitigate that risk.
Okay. Scariest moment climbing so far? It's cold up there too, right?
Yeah, I've never had a moment where I was like, I thought I was going to die. There have been times where I have been crawling or walking on something this wide, where there are 1,000-foot drops on either side, but I'm roped to a guide. But he's not roped to anything. We're not anchored into a wall, okay? So if I have an uncontrolled fall on one side, he has to jump the other side such that the rope then over the top saves both of us. And I asked him if he's ever had to jump. He said, not yet, but I'm only 26. My father's been a guide for 30 years, has had to jump 3 times in his career to save his own life because the amateur he was guiding had an uncontrolled fall, right? Wow. So one of the nice things of doing this is my whole day, I'm so busy and I'm always checking my phone and my email, and my brain is just fried from distractions and the 100 different things I do every day. When I'm out there in the mountains with 1,000-foot drops on either side, all of that is out of my mind. I am 100% focused on every handhold, every place I put my foot, and it really clears my mind and focuses my mind. And just a few days a year, I get to experience this. And the rest of the time, it's just chaos and clutter.
I think that's why Alex loves it up there. He goes up there and it's just it's a form of meditation to a certain extent. You
Yeah,
can focus
it's
on that one thing that's super important.
Yeah, he's written a book that I recommend. I'm an Alex Honnold junkie. I've read all of his, watched all of his YouTubes. There are dozens of hours of videos, and seen all of his interviews and so forth. And there's a purity and a joy and a focus. And when you're free soloing, it's to the extreme, right? There's nothing more than that, where one slip and you're dead. One slip. I, having done, a fraction of that, but having a similar experience, being out there on some similar rocks, I know what he's talking about, but I don't have the same risk tolerance that he does. But look, he doesn't have any kids. He just got engaged, but he's not married yet. Yeah. So the one question I did ask him, the one time I had the chance to meet him at a screening of Free Solo, I said, in the 18 months since you did this climb, have you given up free soloing? Have you now achieved it? And basically every serious free soloist in history is dead. They all die. Interestingly, very few of them die free soloing, right. but they died doing base jumping and other crazy things, right? And he said, I haven't. I've done some great climbs, like Tommy Caldwell and I set the speed record on El Cap, but with ropes, climbing as a team, breaking the 2-hour barrier. He climbed it by himself, free soloing, in 4 hours, which is still very fast, but he was going very slowly and carefully, because a fall, you die. Yeah. Whereas with Tommy Caldwell, he was roped. So he said, I've done some epic climbs since then, but I have not done any free soloing, and I'm not sure. He sort of smiled. He said, I'm not sure if I'm ever going to do it again. I hope he never free solos again, because it won't be climbing the next epic, El Cap or something. He'll die just on some 100-foot face that he could do in his sleep, where a rock hold breaks off. See, that's the problem with free soloing. You can't control a rock tumbling down from above, hitting you in the head and knocking you off the face. So statistically speaking, it is 100% certain Alex Honnold will plunge to his death if he keeps doing this. And I think he knows that. And he just got engaged, and they'll probably have kids. And so I hope he retires at the pinnacle of his sport.
What was it like watching the movie? Did you have a favorite moment, or was it hard to watch?
It was just so exhilarating, but I had this sort of kind of knot in my stomach and the rush of adrenaline that I get when I'm up there on a 1,000-foot wall. And even though I'm roped in to a guide, and the guide is clipped in and all, so I'm doing it relatively safely. There's still things that can go wrong. You can still, even if you're all roped in and everything, a good enough size rock falls from high enough above you, even if you're wearing a helmet, is fatal. A lightning strike can be fatal. So those are risks that are hard to control, right? But I remove 90% of the risk, but I don't kid myself that it's 99%. So I could feel, I've been up there on walls like him. And so it was exhilarating, and it made me want to do it. So when I met him, I said, I want to thank you, and my wife wants to kill you for inspiring me to want to go climb El Cap.
Yeah. And I mean, El Cap is 3,000 feet high. I mean, when you're up there 2,000 feet up, I don't care how many ropes, you look down, you're sleeping on that sheer face. I mean, that's...
Yeah, I mean, look, the moment you go above 60, certainly 100 feet, a fall is fatal. So it doesn't matter if you're 100 feet off the ground or 3,000 feet off the ground. That's what I keep telling myself. Right. Because, when you're up there and it's thousands of feet beneath you, the first few minutes of it, even though I've done it now a bunch of times, my heart sort of races a little bit. When I get there to the base and I look up and I was like, gee, Whitney, is this really the best idea, right? But that's, if I didn't have those feelings, I wouldn't get the same rush from it, the same sense of accomplishment of getting to the top, if it weren't giving me a little bit of a, adrenaline rush.
Yeah. A buddy of mine took me to the highest mountain in the UK, Mount Snowdon, in August. And we had backpacks on because we were camping overnight. And I thought we were just going to walk up the mountain because you can walk it up pretty simple. But he took me over this thing called Crib Gach, which is this kind of knife edge face in between 2 points of that mountain, and it's like 1,000-foot drop on either side. Now you can hold on to things, but I got to the point where I was just like, okay, I just need to focus here.
Right.
Now there's no
and
reason.
You guys weren't roped.
We weren't roped, but I mean, there's enough to hold on to, but
Right.
and I just had to really focus, and there wasn't much turning back. And
Right.
I was just like, wow, you could easily lose it here. And I know people have lost it and they have fallen, or I could just focus on, because 1 foot in front of the other, it was
Right.
fine.
Right.
From a 1 meter standpoint, I'm like, I can do this, but it was just the consequences. But it was
Yeah,
powerful.
well, I just finished a book recently called Deep Survival, and it's a guy who studies calamities out in the great outdoors. You know, sailboats get shredded in a hurricane, climbing, river rafting, et cetera, et cetera. And you and I are the demographic of people most likely to die. Men in their 40s and 50s account for something like 90% of the drowning deaths in Hawaii, for example. And the number of drowning deaths in Hawaii actually is 100% correlated to the number of tourists who come to Hawaii. And virtually all of them are guys like us. And why is it guys like us? It's because, you know, we sort of have a little bit of we swim outside the restricted swimming area. We get ourselves into trouble, right? So exactly what you just described would have been, had you fallen and killed yourself, you would have been yet another exhibit. You would have fit the profile of this book, which is people who are skilled enough to think that they can go do things that they probably shouldn't do. It's not the professional guides who die doing this, right? But it's the people who don't turn around, who don't have the good sense to turn around. And in virtually every case, when someone gets killed, there was an opportunity to turn around where by all rights they should have turned around, and they had summit fever or something like that. So that's one of the reasons why, again, one of the ways I try to mitigate risk is I try to be humble enough to recognize my limitations, but then secondly, I know myself well enough to know that I would get summit fever, and therefore I hire experienced professionals and make sure I'm tied to them at all times. And if they say, you know, Whitney, this has happened to me twice climbing in the Alps, where I was on a tight schedule and I had a flight home, so I had to get to the top of the mountain to make my flight 2 days later. And the guides said, I don't like the weather forecast. And I was like, come on, it looks fine. And they're like, nah, don't like the weather forecast. Because one of the risks is the afternoon thunderstorms come in, you get hit by lightning. So these guides know, these guides don't only keep you safe on the mountain. The best way they keep you safe is to not even go on the mountain at all. They keep you off the mountain when the conditions don't warrant it. And I wouldn't have known, or even if I had known, they're afternoon thunderstorms, I'll just hike fast. I'll get down before the thunderstorms. Those are the people who get killed by the lightning bolt in the afternoon.
Wow. So have that guide. There's a bit of an analogy here in the financial markets.
Yeah.
Have that also, that guide like you that's saying, okay, we're going to not do this, even though all of you wants to go into crypto and pot stocks. I'm going to say no.
Yeah.
Let's have more of a Buffett way of looking at life. And let's live long.
It's interesting. I've never quite pulled it together the way you did, but that's a great analogy where it's something exhilarating, fun, challenging, both investing and mountaineering, let's say. But it's very easy for an amateur to get into trouble and blow themselves up financially or health-wise. And so two things. One, having appropriate humility about your own skill level relative to the challenge or to the other competitors. And then knowing when to hire experts and which guide or expert to hire and to listen to is critical.
5 years from now, what do you want to be doing? Business-wise, personal?
You know, I found when I first started doing, the short answer is exactly what I'm doing now. I love my life both professionally and personally, and you know, Buffett once said, he was asked at one of the Berkshire annual meetings, how do you define success? And he said, if the people who should love you do love you, right? He didn't say make a lot of money or become famous or whatever, right? The people who should love you do love you. And I'm happy to say that every person in my life, you know, I just got back this morning from a week in Kenya with my sister, my nephew, my parents who've retired over there. My sister works there. And my wife and my 3 daughters, knock on wood, all good. And so I'm surrounded by friends and family who I love and who love me, right? So that's the single most important thing. I don't want to screw up. And I just have such an interesting life and do so many fun, interesting things. One of the other reasons I do things like, traveling, I love to travel to far parts of the world. Just in the past, 6 weeks, I spent 2 weeks in Australia, a week in Kenya. And so travel is part of that adventure as well, and has risks that you want to mitigate as well. And then, doing the world's toughest mudder every year, sort of pushing myself physically. I sign up for various trail runs, Spartan Tough Mudder races. So I just have I've got a great life. And then professionally, when I started the newsletter business, I always thought I was going to miss not actually managing money, because I was a money manager for almost 18 years. And I find I don't miss it at all. I actually found it, looking back especially, extremely stressful having responsibility for other people's money. And it made me emotionally make bad decisions. The stress and the emotion of managing other people's money caused me to be more short-term oriented, and to make mistakes, to sell when I shouldn't have been selling, and to buy when I shouldn't have been buying, and so forth. So I actually think by letting my subscribers and my readers manage their own money, and then I can give them the best advice and stock ideas I can, but maintain a little bit of emotional distance. I'm not actually managing their money. Makes me a better investor and a better advisor than I was when I was actually running money. So, the beauty now with Empire Financial Research is my partners at Stansberry Research sort of handle all the logistical stuff, and I get to do two things. The investing side, meaning not actually investing the money, but coming up with good investment ideas, the whole process. I love that game. And then writing it up. And so those two things I've been doing for decades. I love it. I'm good at it. And all the other stuff about raising the money and the compliance and the legal and managing people and blah, 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 I've gotten that out of my life. So I get to do the two things that I love to do. And so I think I found my sweet spot. And so I hope to just, knock on wood, we can build this into a nice, sustainable, successful business over time. And all the outside stuff in my life, that I don't get myself killed climbing El Cap, and maintain good relationships with everyone in my life. And so, just keep doing what I'm doing is my hope in 5 years.
Well, it shows, because I think you have everything firing right in your life. It kind of comes out in your energy. And I think that makes total sense, that since you're not having to actually manage the money, you can actually have a lighter feel about it and be more objective.
Yeah, I can tell you, Neil, not every stock pick since we launched Empire Investment Report last April has worked out beautifully. We've had some big drawdowns on a couple are still in the red. Overall, the portfolio is doing very nicely, and we every monthly issue we list every single stock we've recommended, the date, the price, etc. So we're very accountable and transparent.
Okay.
But I do. So it's no fun when one of your favorite stocks is getting whacked. But I know the feeling now, which is I'm unhappy about it, and I'm redoing my work and trying to figure out, is this an opportunity to buy more? Should I just sit tight? Or maybe I made a mistake, time to sell, right? Those are your only three options when a stock you own or recommend has gotten hammered. But I remember the exact same decisions I made when I was running a fund and managing other people's money. And I remember, I didn't even realize it at the time, but I remember how upsetting it was to me, and how frazzled my brain was, and how emotionally overwhelming, losing money for my investors was. And keep in mind, my investors were my parents, my in-laws, all my friends. So I took it very personally, and you can't invest successfully in a swirl of emotions and taking it all personally. It's very easy to say, hey, look, you got a portfolio of a dozen stocks. Some are going to be down. You're going to make a couple of mistakes, right? It's easy to say. But when you're actually managing people's money and you're losing their money, it can just pollute your brain and cause all sorts of mistakes. And so, now I feel it And obviously I feel badly if one of the stocks I've recommended to my readers isn't doing well, but it isn't the same. I don't feel the same level of stress and pollution in my mind that's going to cause me to make bad decisions.
Yeah. Well, I've been super impressed with your investment reports. I love the transparency. And I'm also super excited for all my listeners and viewers to download this report that you're talking about with this inflection point, you know, autonomous and electric vehicles. It's going to be very interesting. Obviously, link below, londonreal.tv/invest. They can find all about your research. Whitney, please be safe on El Cap. I'm a little jealous. My wife is going to hate you now because I'm going to say, honey, maybe I should go try this.
Yeah.
I haven't thought about Everest, but Kilimanjaro is coming up, and Everest does seem like a stupid thing, right?
Well, you're in London, and it's a very short hop to Zurich and a short train ride to Chamonix, where you can 30,000 people a year climb Mont Blanc, which just hire a guide, and you can do that in a weekend without a lot of training. Yeah, it's interesting. It's the highest mountain in the Alps, but it's also probably the easiest climb of all the big ones because there's no real technical climbing and there's not big exposures. So in fact, one guide can be roped to 2 clients if you want to do it with a buddy. It's mostly just, are you generally in good shape and can you handle 15,800 feet of altitude? Take some Diamox. It's a medication you can take that helps with altitude sickness.
Okay.
So tackle Mont Blanc first, and it's epic and beautiful. And then if you like that, you can fly back to Switzerland, and the Matterhorn would be next on the list, then the Eiger. There's no shortage of mountains to climb in the Alps.
Yeah, the Eiger, oh my gosh. I think you might have just planted a seed today, Whitney. So, all right, I'm gonna start thinking about that.
Let me know, and I know the guides.
You got the guides?
I know the guides I can refer you to.
And I've got your email address
Yes.
as well. So really amazing meeting you, Whitney. Super impressed, and just love this conversation so much. And I think people really love your ideas. And again, I think a lot of my viewers and listeners just don't know what to do when it comes to their money in the stock market. And I think this is a really intelligent, measured approach. And I love this analogy of getting that guide that you could strap that rope to, and you can still go out there and learn and investigate and invest, but you got someone that can just save your bacon out there by just giving you that advice and that guidance. So thanks so much. I know people are going to love all this stuff and love the report. And let's do this again sometime.
Great, thank you.
Okay, thanks so much. Hey, it's Brian Rose, and I've just wrapped filming an exclusive video with Whitney Tilson, who's the American investor, author, and founder of Empire Financial Research, about some exciting investment opportunities in the electric vehicle and autonomous driving space. Whitney actually has been called the prophet by CNBC because of his uncanny ability to predict the future with his investment advice. And our video will not be available on YouTube or anywhere else but the link below. And look, we've all seen the massive moves in Tesla stock recently, and most of us missed it. But Whitney has 5 special investment ideas that the general public have never heard of that will allow you to take advantage of this once-in-a-lifetime opportunity in the electric vehicle and autonomous driving space. The truth is, this sector is going to change everything, from energy to automotive to insurance, even saving hundreds of thousands of lives every year due to traffic accidents. And because you're a London Real viewer, I've managed to get you free access to his groundbreaking special investment report through the link below. Whitney says that we should expect exponential growth in this sector, much like we saw with the introduction of the iPhone in 2007. Just imagine being an investor in Apple back then. How much would you have made? Now look, as a former Wall Street trader myself, I was taught early on in my career that the most valuable commodity is information. So click on the link below or go to londonreal.tv/invest to watch our video and download your copy of this free report. Unfortunately, I've been limited to the number of people who can have access. So act now and get your free copy and take advantage of this incredible investment opportunity.